Continuing now, Trading Day Live.
Hi there, welcome back to Trading Day, just approaching half past the hour. Here's the picture as far as the local market is concerned, about 90 minutes into the session. Off the lows at the moment, down 10.5 points, 6,169. A few stocks in focus, one of which is bigger shares coming online after that cap raising done at a discount. No surprise to see some weakness, down over 6% at the moment, trading just above $7 a share. Also making news this morning.
Put simply, the 2018 results were disappointing and not where we want them.
Yeah, and you're certainly seeing that as far as my shares are concerned. The stock down around about 8% after it posted its first annual loss since listing. And the ACCC has accepted a court-enforceable undertaking from NBN Co to improve its wholesale arrangement with telecommunication retail service providers. Well, to other news, announced actually yesterday, Pengana Capital Group says that it's working on plans to launch an ASX-listed investment trust that will invest in global private equity. It's proposed that the trust will provide investors with exposure to a diversified portfolio of private equity investments. Well, joining us in studio to tell us more about it is the CEO of Pengana, Russel Pillemer. Russell, I do appreciate your time. Lots and lots to talk about. Just to start with, explain what the trust, the makeup of the trust, where we say it's going to be investing in private equity. Just explain that for investors.
So this is an opportunity for investors to invest in global private equity investments. So it's through private equity funds. You often read in the newspaper how fantastic returns are in private equity land, but those returns never seem to be available to the average retail investor. It's either the very large wealthy family offices who get to tap into those opportunities, or alternatively the very large institutional investors. We are now bringing that opportunity directly to retail investors.
And is that a reflection of what you see as being that increasing demand for access to that asset class, as opposed to your direct listed equity exposure?
Yeah, so just like investors have investments in Australian equities, international equities, global private equity as an asset class is growing in demand. It's growing in popularity, and that's really driven by not only the great returns that investors are getting out of private equity, but also by the fact that private equity is somewhat uncorrelated with listed equities. So it makes a lot of sense in investors' portfolios. So we're seeing a lot of demand, but the access points for retail investors is very hard, if not impossible.
And this, correct me if I'm wrong, this will be the first of its kind here in Australia?
This will be the first of its kind in terms of a large trust which is accessing global private equity, which is listed, so investors will have the opportunity to buy in on a daily basis.
Russell, Julia Lee from Valdirect, no doubt that I think this will be quite popular on the market, and private equity has been a booming space. I think there's been $3 trillion that has gone into it over the last 5 years. But at this point in the cycle, competition is pretty fierce for assets as well. We're seeing the highest multiples in this space ever. So if we have a look at the acquisitions in this space, 50% have been on an EBITDA multiple of more than 11 times. So I guess just given the cycle, where do you think we are in terms of the cycle? And do you see, things still continuing to be hot for a number of years, or do you expect to pull back and expect things to get a little bit more cheaper?
Yeah, so I think probably those numbers you were quoting were probably from the Australian context. So we're looking at global private equity. We're also looking at managers which are operating the smaller end of the market. So we're not looking to invest with managers who raise $20 or $30 billion.
It's not your KKRs?
Yes, the big managers like that who are looking to invest en masse in these really large opportunities. The average manager that we'll invest with has maybe $500 million to $1.5–2 billion. So those are the managers that we look for, and those managers are able to access more niche type opportunities, and in the niche type opportunities there are still fantastic returns to be made.
Who's going to be doing the selecting of those funds to invest in? Is it something that you guys are going to be doing?
So we've partnered up with a group called Grosvenor Capital out of Chicago. Grosvenor are one of the world leaders in private equity fund investing. They invest over $50 billion across across their platform in both private equity and hedge funds. So they've been doing this for a couple of decades, a lot of experience, and most importantly, they've got access to these managers who have these abilities and track records of generating superior returns.
And explain the importance of that, obviously the relationships, but how competitive it is to sometimes get into these funds before they close.
So it's almost impossible to access these really great small private equity funds if you're not already an investor with them. So usually they won't take a check for less than $5 or $10 million a piece. In addition, there is so much demand for them that they basically open up their capital raisings in the morning, close them in the afternoon. So unless you've got a good relationship, unless they want you in there, you're very unlikely to be able to access those opportunities.
And I guess having a look at private equity, and the time frame does tend to be longer. Assets tend to be held for at least 3 years, so it does tend to be a longer term proposition. But given that investors in Australia, blue sky is still pretty fresh in their minds. So in terms of pricing those assets and having a listed vehicle, how are you going to look at the underlying valuations of it? How frequently is it going to be valued, and how frequently will
thank you for asking that question, because I think this is something to really stress, and that is, in global private equity, valuations are not a problem issue. And the reason for that is that private equity managers do not get additional fees by marking up their book. So they get their base fees from the initial amount of investment that they raise. If they value up their book, they don't increase their base management fees. In addition, their performance fees are only actually recognised and taken when they finally sell the asset. So you don't have a situation whereby these books are getting overvalued or potentially overvalued over time. So that is not an issue that we face in this portfolio.
You mentioned it's going to be a focus from Grosvenor in terms of global private equity. I mean, is there an expectation that that will include Australia, or is it something ex-Australia?
Look, Australia could fall into the investment universe, or does fall into the investment universe, but Australia is a very small part of the world, as we know. I think in listed equities, it's less than 2% of the world. In private equity, I would imagine similar types of numbers. So we might see 1 or 2 Australian opportunities in the portfolio, but not more than that.
What's the expectation? I know it's early days, but the expectation for demand, the feedback you're getting, particularly at a time where there's a lot of talk about asset allocation, and pushing away from simply having that, that direct equity exposure.
Yeah, so we think this should form part of every investor's portfolio. It helps balance out your portfolio, give you higher returns, lower correlation with other asset classes. We see probably examples in the marketplace which would give you an indication of what it could be like. For instance, the Future Fund, they came out recently and said they've allocated 14% of their portfolio to private equity. So I think that's the opportunity that's out there. All the financial advisors that we're speaking to are looking at this in terms of portfolio construction, how much they should have. And likewise, direct investors are also looking at this as a way to invest money in a market that might be considered to be quite toppy at the moment. This is another way of accessing it.
So I guess the key question, it is a fund of funds, so what about the fees involved?
Yes, so obviously being a fund of funds, the underlying managers charge fees. At the unit trust level, the listed vehicle level, which Pengana together with Grosvenor runs, we charge a base management fee of 1.25%, and then we take a performance fee of 15% above an 8% return. So unless the returns are in excess of 8%, there will, at the trust level, there will be no performance fee taken by the manager.
And just finally, Russell, timeline. What are you guys working on in terms of, because I know it's something you're working towards, but when can investors potentially be looking at an opportunity with the trust?
So this will be into the new calendar year. We are spending time with investors at the moment, educating them, spending a lot of time with financial advisors, showing them how this can fit into their portfolio allocation. A lot of financial advisors are thinking about the sizing in their portfolios. Should it be all the way up at 14% or 3 or 4%? So that's a lot of work that's been done at the moment. In the new year, investors will have the opportunity to invest.
Fantastic. Russel Pillemer, do appreciate you joining us this morning. Thank you.
Thank you very much.
Well, moving on now, the treatment of customers attempting to cancel unwanted life insurance policies had been the focus of the Financial Services Royal Commission this morning. Freedom Insurance's Craig Orton was grilled as to why it makes it so hard for customers to cancel policies and the company's treatment of a father whose son was sold a policy despite suffering Down syndrome. Leo Shanahan joins us now. And Leo, just how common is it for Freedom customers to try and cancel these policies, and I suppose what are companies doing to actually talk them out of it?
Yeah, well, James, it's very common apparently. Within about the last 13 months, Freedom customers, about 37,000 Freedom customers have attempted to cancel policies sold to them mostly over the telephone. Now, that's about 70 calls a day to Freedom in attempts to cancel these policies. Now, despite this, about 80% of those policies are retained. Now, that's because when someone rings up to say, I would like to cancel my policy, please, they're not actually told straight away that they can do that. They're passed on to what's called a cancellation unit. It's actually a retention officer. Now, it's that person's job to keep that person on the line and hope and convince them that they can keep their insurance policy. So that behaviour was under the microscope this morning. Craig Orton from Freedom, more uncomfortable questioning from him. Also, we went to the case study again of Grant Stewart. Now, this is the father of a young man who had Down syndrome that was sold one of these policies by Freedom despite obviously suffering from a disability. He himself was put on to one of these retention officers after complaining twice about his son's policy. He was eventually able to cancel the policy, but only after some pretty shabby treatment from the company itself. And just take a listen to Rowena Orr questioning Craig Orton over the treatment of Mr. Stewart. Okay, we don't have that one, but look, we then went on to the questioning of really the viability of a model for Freedom in the future, given the regulatory crackdowns that are taking place. And keep in mind, Freedom is trying to get an APRA licence at the moment. I understand that's very unlikely to go ahead. They're attempting to become a full insurer. Now, their share price is down to about 12 cents. And I really question, as did Rowena Orr, whether they can actually maintain their business model under this level of regulatory scrutiny and really the changing of the laws.
Absolutely. Leo, appreciate the update. Thank you very much for that. Leo Shanahan there, live at the Royal Commission in Melbourne. We need to take a break. When we come back, a little bit more analysis on the session at hand with Shaw and Partners, so stay with us.